In October, Bitcoin hit an all-time high of about $126,000. 8 months later, it was worth roughly half that. If you bought at the very top, you're down more than 50% right now. And the uncomfortable truth is, most beginners buy at exactly the wrong moment. So before you put a single dollar in, here's everything I wish someone had explained to me first. If you've ever opened a crypto app, watched a number go up, and felt that pull to jump in before you miss out, this video is for you. I'm not here to tell you crypto is a scam, and I'm not here to promise you'll get rich. I'm here to give you the beginner's guide I never had, the plain English version with real numbers, no hype, and no jargon I don't explain. By the end of the next 15 minutes, you'll understand 4 things. 1. What crypto trading actually is, and the single most important feature that makes it different from a normal savings account. 2. The one piece of math that explains why so many beginners lose money even when the price eventually recovers. 3. A realistic, step-by-step example using a character we'll call Marcus so you can see exactly how $1,000 can turn into less than $500 in a matter of months. And 4. The 5 most common mistakes new traders make and the simple fixes for each one. Let's start with the basics, because almost nobody explains them properly. So what is crypto trading, really? At its simplest, it's buying a digital asset, like Bitcoin, hoping to sell it later for more than you paid. That part sounds just like buying a stock. But crypto has 3 features that make it behave very differently, and understanding them is the whole game. First, there's no off switch. The stock market opens in the morning and closes in the afternoon. Crypto trades 24 hours a day, 7 days a week, 365 days a year. The price can move 10% while you're asleep. There's no closing bell to give you a moment to breathe. Second, there's no central authority setting a fair price. A share of a company is tied to that company's earnings, its profits, its assets. A lot of crypto's price, especially in the short term, is driven by supply, demand, and pure human emotion, fear and greed bouncing off each other. When people are euphoric, the price can run far above anything reasonable. When they panic, it can fall off a cliff. And third, this is the big one. Crypto is extraordinarily volatile. Volatility just means how violently the price swings. And here's the piece of math almost no beginner internalizes until it's too late. When you lose money, you don't need to make back the same percentage to break even. You need to make back more, a lot more. Let me show you. Say you put in $100 and the price drops 50%. You now have $50. To get back to 100, you don't need a 50% gain. You need a 100% gain. Your money has to double just to break even. And it gets worse the deeper you fall. A 70% drop needs a 230% gain to recover. An 80% drop needs your money to go up 400% to 5 times what's left, just to get back to where you started. This isn't a scary hypothetical. It's exactly what happened. Back in late 2021, Bitcoin hit about $69,000, then fell to around $15,600 the next year. That's a 77% crash, meaning anyone who bought near that top needed a 340% gain just to get back to even. It took roughly 2 years. And this is why the headlines about people getting rich tell you only half the story. There's a study from the Bank for International Settlements, basically the central bank for central banks, that looked at crypto exchange data across 95 countries. They estimated that somewhere between 73 and 81% of retail investors likely lost money on their initial Bitcoin investment. Not because crypto doesn't work, but because of when and how people bought. They piled in when the price was high and exciting, and sold when it was low and scary. The asset went up over the long run, but the average person still lost. So, the core concept is this. Crypto trading isn't really a test of how smart you are about technology. It's a test of how well you handle volatility and your own emotions. Hold that thought, because in the next section, I'm going to show you exactly how it goes wrong, with actual dollars. Let's make this real. Meet Marcus. Marcus is 28. He's got a steady job, and in October of 2025, he keeps seeing the same thing everywhere. On his phone, from his coworkers, in every comment section. Bitcoin just hit $126,000, an all-time high. Everyone he knows seems to be making money, and he's the only one missing out. So, salmon does have iron in it, but it's not a lot. He takes $1,000, money he was kind of saving, kind of not, and he puts all of it in, all at once, right near that $126,000 peak. Let's do the simple math. $1,000 at $126,000 per coin buys him about 0.0079 of a Bitcoin. Write that number down because it doesn't change. He owns that slice no matter what the price does next. Now here's what actually happened over the following months. The euphoria faded. The price slid. By the middle of 2026, Bitcoin was trading around $60,000, a fall of about 52% from the top. So what is Marcus's slice worth now? That same 0.0079 of a coin times $60,000 comes out to about $476. Sit with that for a second. Marcus put in $1,000. 5 or 6 months later, he has $476. He lost $524, more than half his money, without doing anything reckless, without leverage, without some obscure scam coin. He just bought the single most well-known asset in crypto, at the wrong time, in the wrong way. And remember the math from before. For Marcus to simply get back to even, not to profit, just to break even, Bitcoin has to climb from 60,000 back to 126,000. That's a 110% gain. His money has to more than double from here just to undo the damage. That could take years. It might not happen at all on his timeline. Now, and this is the important part. The asset itself isn't the villain here. Bitcoin has recovered from brutal crashes before. The problem was never the coin. The problem was Marcus's two decisions. He bought because of fear of missing out at a euphoric high, and he put everything in at a single moment in time. Two choices, both fixable. And in the next section, I'm going to show you the exact fixes, including one simple approach that, with the same money and the same market, would have left Marcus in a completely different position. Marcus made two classic mistakes, but there are 5 that catch nearly every beginner. Let's go through all of them and the fix for each. Marcus made 2 classic mistakes, but there are 5 that catch nearly every beginner. Let's go through all of them and the fix for each. Mistake number 1, buying all at once at the top because of FOMO. This is the Marcus mistake. The fix has a name, dollar cost averaging. Instead of dumping your whole stake in on one day, you split it up and buy a fixed dollar amount on a regular schedule, say $100 a month, regardless of the price. Let me show you why this is so powerful with a simple, made-up price path. Imagine a coin that over 6 months goes $100, then $80, then $60, then $50, then $70, then $90. If you invest $100 every single month, your fixed 100 buys you more coins when the price is low and fewer when it's high. Add it up, and you've put in $600 total at an average cost of about $71 per coin, even though you started buying at 100. When the price finishes at 90, your stack is worth around $760. That's a 27% gain. Now compare that to going all in with the full 600 at the start at $100 a coin, you'd be sitting at a 10% loss. Same coin, same 6 months, completely different outcome. The only difference was spreading it out. Mistake number 2. Investing money you can't afford to lose. New traders constantly put in rent money, emergency fund money, money they need next month. And then volatility forces them to sell at the worst possible time because they had no choice. The fix is position sizing. Decide in advance what slice of your money you're willing to see go to zero and treat that as the maximum. A common conservative starting point is something small, like 5% of your investable money. If you have $10,000, that's $500 in crypto. If that 500 somehow went all the way to zero, worst case ever, you'd still have 9,500. You'd be annoyed, you would not be in crisis. That's the whole point. Mistake number 3. Overtrading and getting eaten alive by fees. Beginners think trading more means earning more. Usually it's the opposite, because every single trade costs you. Let's say your platform charges around 1% each way, 1% to buy, 1% to sell. That's 2% every time you go in and out. Doesn't sound like much. But say you've got $1,000 and you make one round-trip trade a week, moving most of your balance each time. 52 weeks, 2% each? That's more than 100% of your starting balance paid in fees over a year. Even if your trades broke even on price, the fees alone could have wiped you out. The fix? Trade rarely and deliberately. Every trade should have a clear reason, not just the chart looked exciting. Mistake number 4. Leverage and chasing the next hot coin. Leverage means borrowing money to make a bigger bet than you can actually afford, and in a market this volatile, it's the fastest way to lose everything. A small move against you can wipe your entire position to zero. As a beginner, the answer is simple. Don't. Same goes for chasing whatever tiny coin someone online swears is about to 10x. For every one that goes up, dozens go to zero quietly. The fix is boring and effective. Stick to large, established assets while you learn, and ignore the lottery tickets. Mistake number 5. Ignoring how you actually hold your crypto. There's a saying in this world, not your keys, not your coins. If your crypto sits on an exchange and that exchange fails or freezes withdrawals, which has happened to some very large ones, your money can vanish even if you did everything else right. The fix is to learn the basics of security early. Use strong, unique passwords. Turn on two-factor authentication. And once you understand it, look into moving meaningful amounts into a wallet you actually control. You don't need to master this on day one, but you do need to respect it. 5 mistakes. FOMO buying, betting money you need, overtrading on fees, leverage and lottery coins, and ignoring security. Avoid those, and you've already sidestepped the traps that catch the overwhelming majority of beginners. Now, if even one of those 5 just saved you from a mistake you were about to make, do me a quick favor and hit subscribe. This channel is built entirely around helping beginners understand money without the hype, and there's a lot more where this came from. In fact, If Marcus's story hit a little close to home, that pull to buy because everyone else is, I made a whole video on the psychology of FOMO and how to trade against it, and I'll link it right up here. If you want to go deeper on protecting your money, my video on the risk management rule the pros use breaks down exactly how to size your bets so a single bad trade can't sink you. And if you're realizing that slow and steady might beat fast and risky, the video on compound interest and why starting young matters so much is a great next watch. Go check those out. They pair perfectly with what we just covered. So, if you take just one thing from this entire video, let it be this. In crypto, success isn't about predicting the next big move. It's about surviving the volatility long enough to be there when it matters. The people who lose aren't usually the ones who picked the wrong coin. They're the ones who bought out of fear, bet money they couldn't lose, and panicked at the bottom. Slow down, spread your buys out, risk only what you can afford to see go to zero, and let time do the heavy lifting. If you found this helpful, the FOMO video I mentioned is the natural next step. It's the missing half of this conversation, all about the emotional side of trading. And once you've watched that, the risk management and compound interest videos will round out your foundation. I'll see you in the next one. And that's a wrap on today's topic. If you found this helpful, be sure to hit like and subscribe so you never miss a lesson. Have a question about what we cover today? Drop it in the comments below. I'll be answering the best one. If you want to dive even deeper, click on this next video right here, where we explore next topic. Thanks for learning with me today, and I'll see you in the next one.